So back in 1997, I used to work on Wall Street, and I was opening new accounts over the phone, and people were buying stocks. And there was we all had licenses, but there was a whole boardroom of us that were on the phone, talking to people and presenting the same stock over and over again. And what happened is during that time, the stock market was running. And I not only was opening new accounts over the phone, the money I was making, I began to buy internet stocks. And if anybody that's watching this video can go back to the late 90s, there was a time for about a year, maybe a year and a half, that internet stocks were going from here all the way up to here. And it was happening real fast. And I'm going to say it wrong, but think of Doge or Dodgy coin. It was the same thing, except it was the late 90s. And for example, when I used to get my hair cut, the guy that used to cut my hair, he once gave me a recommendation, and the stock went from 5 to 340, not making it up. So what happened is, and this is me not being educated, all of a sudden, the internet stocks just stopped performing. As a matter of fact, they went back from 300 back down to 2. So not only the money that I was making by buying these stocks for clients in the form of a commission back then, but also my own personal investments, they were all the way up here and they went down to here. And it all happened within 2 weeks. The lesson that I learned in 2000 led me to the question that one of our viewers asked: can you have multiple life insurance policies? Once again, going through that experience of not only just being in one sector, which was internet stocks, and those stocks eventually began to go down precipitously. And by the way, there was no calamity bell. There was no warning that in March of 2000, it was just going to start going south. We had no idea. We thought it was going to last forever. I'm sure there's some people out there that can relate to that. But once it happened, it began to put me into a different trajectory and really get educated in the business that I was in. And part of that education came around 2003 when a gentleman came and sold me my first life insurance policy. And that was when everything changed, not only for me, but from an education perspective for all the clients that come through the Epic doorways. So when you purchase life insurance, there's a couple different things you have to do. You have to do a physical underwriting, which is really a blood in the urine, and you also have to do a financial underwriting. So my first policy was back in, let's say, 2003, 4, or 5. I don't remember exactly what year. And it was a term insurance policy first, and then soon after that I bought my first whole life. And the gentleman that brought me the whole life policy, phenomenal. He was the face of Guardian for 20 years. I'm not going to mention his name, but he was the guy that really understood life insurance in a global way and how it could sit and fit with your overall planning process. And when he came to me, he purchased, in his world, he used to buy a lot of real estate, but his version of real estate was buying the ground that, let's say, a McDonald's or a post office was on. Let's use McDonald's, for example. He wouldn't own the franchise, he wouldn't own the McDonald's, but the land that it was on, he would own. And it was called the triple net ground lease. The triple net stands for taxes, maintenance, and insurance, which means McDonald's will not only pay the taxes, the maintenance, and the insurance, but also pay for the land that the McDonald's is on as well. So if you own the land, you're going to be able to not have to worry about if the snow has to get removed because McDonald's has to pay for that, or if there's a broken glass because McDonald's has to pay for that. The point is, this gentleman used his life insurance cash values to purchase a bunch of ground leases. And he wound up owning probably 15 or 20 different ground leases that all these McDonald's that were on all across America. And he made a lot of money doing that. And each time he began to elevate financially and his income increased, he would buy another policy. And he would rinse and repeat and buy another policy, so on and so forth, to the tune of where he owned, I think the last count was about 42 different policies. So the question is, can you own all these different policies? The answer is yes, and it's really not only based on health, but it's also based on as you climb economically. But also, I'll use me as an example. There's 2 people that worked with me years ago, and I wanted to make sure that they kind of stayed with what we were doing, so I purchased 2 policies on them. It's called Key Man, Key Woman policies, right? It's also called the Section 162 double bonus plan. I also have policies on my 3 children because eventually I like to use their policies to pay for college if they don't get a scholarship. So there's all these different tools, techniques, and strategies that you could use by owning multiple policies that could be tied to your business, that could be tied to your net worth, that could be tied to your overall banking strategy. And being able to do that, understanding that there's many different whole life policies. And oh, by the way, If you get the proper indexed IUL to complement your whole life policies, what could really begin to happen, providing you overfund it and accelerate the cash value, if the stock market continues to climb, that IUL can take advantage of that ride and complement everything you have on the whole life side. Listen, here it is. If you get a high cash value whole life policy and overfund it, right? So you put in 100 grand and you have 90 grand that you can access and go buy a piece of rental real estate and have your renter pay back the policy. As your real estate climbs, you can go buy your next policy and rinse and repeat that model and create that concept of multiple policies with multiple banks. Think of every policy as a bank. If in fact you're an entrepreneur and you have, let's say, 5 different pieces of real estate that are tied to 3 different policies, but you also have 2 children, you could then set up other policies that are specific for your children's education. And along the way, those policies could purchase real estate and the renter in those policies could pay back your child's bank and also their child's education. If you wanted to use life insurance to buy real estate, that's how you become your own bank, right? You're doing exactly what the bank does. You're getting multiple use of each and every dollar. If you're looking for estate planning and you want to make sure that there's a death benefit in place to cover estate taxes upon the death of the second spouse if married, or if divorced, that could be paid at the death of the spouse. There is life insurance trust that could be set up with certain other policies. And last but not least, if you're looking to complement your 401k, because remember, your 401k, when you take income off of it, it's going to get taxed at ordinary income, right? So if you have a traditional whole life policy that you've been funding for 20 or 30 years, the money that comes off that whole life policy is going to be income tax free and is a perfect complement towards any kind of taxable investments that you have. I just gave you 3 different scenarios, 4 if you include the Gerber plan, when it comes to how to buy multiple policies for multiple uses that sit and fit with your core values. So for you that's watching this video right now that wants a true education and there's no expectation to do business with us, go ahead and click the link below. The member or one of the members of the Epic team will reach out and take you through that educational conversation.